How's it going, everybody? Welcome back to another episode of Smart Money, Smarter Moves with our CIO Kyle Cain at Freedom Family Office and your host, Sameer, Director of Client Engagement here at Freedom Family Office. Super excited to come back to you guys. I know it's been a couple of weeks since we've talked to you guys. And again, the whole goal with our podcast is to be able to provide you driven market insights in the same amount of time it takes you to get a coffee. Our clients are busy entrepreneurs and we know how busy you are. So we want to make our advice and commentary as fast as possible so you can get your coffee, be on the go, and get to your busy day. So, Kyle, it's September 5th at the time of us recording this, and our audience members will see this next week. Maybe share with us about overall the month of August recap. Where are we at? I know there were some job numbers recently. We had some earnings this week. You saw some tech moved. Google moved 8 or 9% up on some news about Google Chrome, I think. Maybe just give us the overview, what you're seeing in a little August recap.
Yeah, so I mean, it's been another really if you kind of look at the markets, a lot of people may think, we haven't done much, except for just move up slightly, but there's definitely been a lot of things that have happened this month. I mean, obviously don't have time to go through all of them, but overall S&P 500, was up about 2%. The main things driving that was continuation of earnings season, which we'll talk a little bit about here. And ultimately then the Jerome Powell's Jackson Hole meeting and the thoughts that now we should be able to get a rate cut here in a couple weeks in September, right? So, like I said, first let's put the markets in perspective for a second here. Like I said, it's been a good year so far. Through August, we're up about 10.8%, something like that. But again, it's been another year driven by the Mag 7. All right, if you take out the Mag 7, we're only up about 3 to 4%. I forget the exact number is, but it's, around 3%, 3.7%. All right. So it's another one of those years, just like it's been the past few years, where Mag 7 is driving it. And why? It's because the earnings are there. Right. It's been another year. Earnings were up, about 30% for the Mag 7 versus about 5 for the rest of the index. So, it continues to deserve the weighting that it has in the index, and it's continuing to be the market mover. The other, data that came out this month, GDP came out revised a little bit higher. Obviously, there's a lot of concerns about how tariffs are going to impact the consumer and business profit margins. Well, first GDP, it was revised up a little bit, showing better consumer spending and better investment spending. So far, economic data is holding up. We're not seeing the tariffs being passed through too much in the earnings data. On the earnings calls that it came through, there's definitely been several companies who have came out, mainly on the retail side, that said how it's going to hurt their businesses this year because they're eating a lot of it. They're not, quite yet passing it on. But I think in a lot of the survey data, we're going to start to see them passing more of that on, and we're going to see inflation continue to rise over the next several months. All right. But earnings has been great. Earnings are up about 12% overall for the quarter, which compared to coming into the quarter, was expectations were less than 5%. So it's been another, home run. So again, the thought of good GDP, higher earnings, and then now the Fed, even though we know inflation's moving up, that the negative side is job data. The job report just came out today. If you remember last month, it was a big disappointment in the job data, and it was revised down for the previous 2 months. Well, same thing. This month, it showed only 22,000 jobs added for the month. And then the previous month were revised. So it showed that June, you actually lost jobs in June. And then next week, we'll actually get the annual revisions, which the past few years, in a couple of years ago, we were getting 300,000 jobs, 300,000 jobs created every single month. And then we get the annual revisions where it's 800,000 jobs were created. So a lot of economists are expecting next week that the revisions will push it down even further. So that goes back to the mandate of, the Fed trying to weigh inflation, keep that contained versus, make sure the employment is holding up. And so based on Powell's comments and today's job report, as we discussed in the last podcast, it's probably all but certain that we're going to get, a Fed cut here in the next couple of weeks. The market's pricing in about 100% chance. It's actually, pricing in about a 15% chance for a 50 basis point cut. Don't think that's going to happen. We'll just get the 25 basis point I do think that tariffs, again, they're going to create inflation, but it'll be a one-off. We'll start to see it come over the next several quarters, and then throughout 2026, they'll start to be able to receive. Businesses can't continue to raise prices after the adjustment period has been made. The big question is, and what Jerome Powell mentioned in his Jackson Hole commentaries, sometimes when the job market gets to an inflection point where we're starting to see, job openings less, we're seeing private employment less, we're getting the jobs report growth showing, pretty flat month to month growth. Sometimes at an inflection point where unemployment can rise drastically. Like it's like a spiral effect that can happen. And a lot of the survey data shows that businesses, are looking to cut costs somehow. Again, you can look at it different ways, right? Like companies, their board of directors are telling them keep spending in AI. Well, where are they going to get this money from if they don't want to hurt their margins? One way they can do it by cutting employment. So that's kind of where we stand at. Still a good month, but valuations are high. On Nvidia is the other thing that didn't wanted to touch on. Right, again, beat earnings, beat revenue, but it sold off. Right, why did it sell off? The data center growth sort of disappointed a little bit, and you know, and and that's what kind of got most of the headline. I think more so than that, Alibaba came out saying that they, are producing chips for China now, and I think a lot of the big upside, Nvidia they didn't include in any of their data for this quarter or for their guidance for next year. You know, China sales, right? Like could be they didn't do any H20 sales last quarter. They now, as got permission from the administration to sell H20, but as long as they're paying the government 15%, of revenue. So point is that could help them beat earnings again next quarter. But the thought that, China's pushing back and saying that they might be buying chips from other places has probably been the main catalyst. So overall, I'm trying to say that the AI tray isn't done yet. Broadcom just reported they killed it. So it's still there. Again, it's just at the margins on who's benefiting. And when you have NVIDIA, you're trading at a forward PE of about 42, any sort of miss, or lower expectations can cause a quick sell off.
Are you bullish going into this next quarter?
So I am, right. I think ultimately the companies are starting in 2025 to benefit from the tax bill. Consumers really aren't going to start to benefit until 2026, but businesses are. The lower dollar still, going to help earnings. In my opinion, I don't think employment is going to fall off a cliff. I think it's going to continue to hold up. I expect volatility. We haven't seen much volatility. I would be, if we do get, so I wouldn't be surprised of a sell off in the markets. If so, I'd be a buyer of it. I still think that ultimately, even though we're, expensive and the economy is slowing, I think it's going to hold up. And then once we start to get tax bill and deregulation, going into next year, that's going to be the next sort of catalyst to push, earnings even higher into next year.
Yeah, thanks, Kyle. That's helpful to know going into this week. Well, we'll be back with you next week. In the meantime, if you want Kyle's insights, Kyle, you just released your monthly insights for August, correct?
Yeah, I just wrote it up today. That should be going out. So if anyone wants it, feel free to jump on the list.
Yeah, so jump on the list, follow Kyle on LinkedIn. If you want to be added to our email list, go ahead and put your email in our LinkedIn comments, or you can email me directly at Sameer@freedomfamilyoffice.com. We'll get you on our email list to get you Kyle's insights, and we'll see you guys next week for another episode of Smart Money, Smarter Moves. Thanks, Kyle.
Thank you.